Hello everyone and welcome to this MODEX webinar with JBA Risk Management. In this webinar we will explore how climate change has changed in the past, what scientists project in the future, and the impact this may have on flood risk and financial loss. Our presenters today are James Slay, Commercial Director of MODEX here at Simplitium, and we also have Sarah Jones from JBA Risk Management. So today we will start with an introduction to MODEX. This will be followed by observations and projections around climate change. We will then look at the impact of climate change on flood risk and financial loss, followed by an overview of JBA's UK climate change flood model. You can ask questions throughout the webinar using the GoToWebinar menu, and all questions will be answered at the end. With that, I'm going to hand over to James Slay, who is going to provide the introduction to MODEX.
Many thanks, Emmy, and welcome everybody to this afternoon's webinar. First and foremost, I'm going to do an introduction to the MODEX platform, what we're doing, and kind of why we're working with JBA in this particular case. So let's get started. We're providing a multi-vendor cat risk modelling platform which is operated on the OASIS loss modelling framework. By doing that, we're unifying multiple vendors and systems under a single platform, and we're creating a nice little ecosystem of model providers right now, which are giving access to some fantastic science via the OASIS framework. We deliver it via a fully hosted and managed service, so in that way we're making this as simple as possible for people to access and deploy, and you can really get up and running very quickly. We do this through an independent platform, so basically we don't develop models ourselves, and we won't ever develop models ourselves, so we're distributing these via a platform, and all of our development effort is spent on making that as efficient and transparent as it can be to the user population. So some of the benefits of why we're doing this. We want to bring more choice to the market, and I think that's a very important point, because there are some fantastic models out there, and effectively people need a way to access them efficiently, and by bringing it all under one platform such as the MODEX platform, you get access to those models in a really quick and efficient way. We're also encouraging model development by providing a marketplace for these models to be consumed by the insurance and reinsurance community, and of course that will therefore encourage developers to update their models or produce new models. We don't require any IT expertise or client-side install, so effectively there's no IT project, there's no acquiring new hardware to run this stuff. It's literally a web-based system, so all hosted our side. You get access via a browser, and that's all that needs to happen. The OASIS financial module provides a consistent way to calculate losses through the system, so you can in effect compare models of a similar kind, so two earthquake models or two hurricane models, for example, side by side using one financial module, so you know that any differences in the results are purely down to the model design and build rather than something that's platform specific. So a powerful tool for kind of testing and validating models, and we are bringing this under a shared platform, so we have economies of scale at the compute end of the environment, and we will pass those economies of scale onto our clients. So effectively we are providing a one-stop shop for risk management, and by that I mean a nice ecosystem of tools and models that you can access in one place without having to move data around, shuffle it between systems. So on the cat model front, we have multiple vendors available on our system today, and so you can see those here on the screen. JBA, of course, one of our key model vendors. We are also distributing hazard data, so we have data from JBA again, and UCL Fathom right now. We are connecting with tools that enable you to look at reinsurance financial structures. So through ModX today, you can pass data straight into the Tiger Eye platform, and we will have more systems being added to that as the year progresses. We also offer a system for evaluating models. So right now we've got models from impact forecasting, from ARA and from JBA, all within our model evaluation system. This is a separate system from our production environment. It's purely there for people to get a look and feel of these models. You can test the ModX system, you can test Oasis, and you can get some real results out of these models all under one platform. And with the permission of all of these vendors, that is a free service that we offer. So I think it's something that people can really take advantage of to get some real life experience of the Oasis platform as it stands today. So why are we here today? So we're talking about climate change and the assessment of risk of climate change. I think it's fairly clear that these risks are present, and we're seeing some change in frequency and severity, and when we think about that for the future, we could be seeing increased or decreased rainfall in certain areas, so leading to flood or drought in some cases. We're seeing higher temperatures like we've been experiencing for the last few weeks, and there are implications for effects of heat waves. Sea level rise is a concern, especially for coastal erosion and of course sort of surge based flooding, and certain areas may be subject to increased windstorm intensity. I think it's clear that the UK based insurance and reinsurance sector has significant capabilities in evaluating the effects of climate related risks and quantifying the damage that these perils can cause, and it's a well managed market, and I think the broader finance sector would benefit from the insurance market's knowledge on climate risk, especially as it relates to infrastructure and of course downstream supply chain impacts. Climate risk is also poorly incorporated into kind of business planning processes as it stands today, and I think risk management practices could be incorporated much better into corporate planning and valuations and decision making. So I think businesses and government are only at the beginning of their understanding of how to measure and manage potential climate risk, and there's still a significant knowledge gap about the scale of climate risk, and a big opportunity for providing adequate insurance protection, and I think that's where we can come in and help. So without further ado, on that note, I will hand over to Sarah Jones from JBA to talk to us a bit more about their UK climate change model for flood.
Hi everyone, it's Sarah Jones here at JBA Risk Management. I suppose I wanted to start off by getting everyone thinking about what you think of when you hear the term climate change, because we have heard a lot about climate change over the last 10, 15 years now, especially in the media. And I wondered whether you think of perhaps the kind of big industrial economic aspects of climate change, or whether you consider the flood and extreme events that we experience in the last few years, or perhaps it's greenhouse gases, melting sea ice. All of these things mean that most people have an opinion on climate change, and it does mean different things to different people. Over the course of the next 30 minutes or so, I really hope not to bore you on the topic of climate change, and hope to kind of pique your interest a little bit and get you thinking a bit more about how it might impact our industry. Because essentially climate change will affect us. We have experienced an increase in extreme events recently, and projections suggest that this trend is set to continue in the future. Now, with stats such as those on the screen that you can see now of around 5.3 million properties at risk, this will have a knock-on effect on our industry, and not only the properties at risk, but also the number of claims that we also have coming through. So I wanted to start off by just talking a bit about climate change very broadly now. So taking it right back to the starting point of what is climate change? Well, the IPCC, which is the Intergovernmental Panel on Climate Change, the international body for assessing science related to climate change, define it as thus that is on the screen now, essentially a change in the state of the climate that persists for an extended period, typically decades or longer. Now, JBA are the flood people, but we do have climate expertise as well. And what we do is we utilise expertise for both internal and external to then apply to our services and our products. Well, what are the actual causes then of climate change? 90% of the global climate scientists agree that the climate is warming and that this has been accelerated in the last 150 years due to anthropogenic forcing, which is, in essence, human influences. This is reflected in the UK observations with warming temperatures and increasing precipitation. And I've just included a nice plot here from Meal et al. That just showcases this a little bit more. So essentially in the black line, we have the observed change in global average temperature. Overlaid with that is a blue line that you can see, which is the natural forcings. And this encompasses things like volcanic eruptions and solar variation as well. We also then have the red line, which is the anthropogenic and natural forcings combined. So not just volcanic eruptions and solar activity, but also emissions of greenhouse gases and other harmful toxins. And what you can see from this plot quite clearly is that the combined forcing of anthropogenic and natural fits really nicely with our observed change in global average temperature, supporting the IPCC statement. Now, this is obviously a presentation about the UK, so what influence will that have on climate change in the UK? Climate model simulations do project warming to continue over the UK, increasing moisture within the atmosphere and leading to more frequent rainfall extremes and flooding. I've put on a few stats there just for information for you, and I'd like you to take note of the first one, that 2016 recorded the hottest year since observations began. 2017 was the 5th hottest. Now, the Met Office has just released a blog a few days ago, I think 5 days ago, that says that actually 2018 could now be one of the hottest years on record as well. And some parts of East Anglia and South East England have actually had virtually no rain in more than 55 days. Now, for those of you in the UK, you might be really enjoying the dry, warm weather that we've experienced over the last couple of months. But although we have had a dry summer, we are still at risk of flood events. For example, in Birmingham last month, we experienced some flash flooding. And over the weekend just gone, the 28th and 29th of July, we've had 1 month's rainfall in 2 days. The image on the right that you can see looks a bit scary, so apologies, but essentially it is rainfall anomalies for each country within the UK and for the UK as a whole since 1910, when records began. It's rainfall anomalies expressed as a percentage difference to the long-term average and is taken from the UK Climate Change Risk Assessment from 2017. It highlights a positive trend in rainfall, especially within the last 20 years. So what are the implications then for flood and finance? Well, sorry, I'm just having difficulty moving along slides here. Well, we know that the relationship between climate change and flood events is complex. Evidence does suggest that the UK has experienced more heavy rainfall events, as I mentioned previously, and that with more extreme rainfall, we will experience more flood events. This will relate to the industry as an increase in financial loss. And UK Flood Model 2018, released by JBA, has actually shown that the estimated annual average loss for residential properties is currently in the region of £450 million, with 1 in 5 properties at risk to flood in Great Britain. So then, if that's the case now, what does the future hold for us? Well, research does suggest that, as I've mentioned, with increasing rainfall, we should experience an increase in surface water flood events. Increase in extreme water levels could increase the risk of coastal flooding alongside sea level rise. But actually, summer river flows are projected to reduce by the 2020s. However, there is limited research that quantitatively analyses how insured losses may change with flood risk in the future due to climate change. One source of information that we can look at is the UK Climate Change Risk Assessment, which I mentioned on the previous slide. Now, the 2008 Climate Change Act requires the UK government to compile an assessment of risks for the UK arising from climate change, and that's done every 5 years. DEFRA have responsibility for this, and they publish a series of reports, with the latest being the UK Climate Change Risk Assessment 2017. One of the key risks identified in this report is flooding and coastal erosion, and so they have focused on projections of future flood risk in the UK. They use information available from the EA, SEPA, Met Office, and plenty of other organisations. But essentially, in other words, it is government-approved science. And I've just included one of the headline results that you can see on your slide here, that the number of properties exposed to frequent flooding will increase by 20% compared to 2014 figures by 2050. However, there is currently no catastrophe model on the market that has the capability to project future financial loss. And this is where JBA's UK Climate Change Flood Model comes in. JBA has identified that there is a need for a climate change flood model in this market. And you might be wondering, well, why do I need this model? Well, we recognise that climate change will have an impact on our industry. And we also understand that there are limited tools available. So we have tried to develop one to help you better understand the impact of climate change on your portfolio in the future. Hopefully, this should enable you to act and take decisions now to implement changes earlier rather than later, because we all know that change over a longer time is much better than rapid change over short timescales. And we also recognise that there is a need for an adaptation period. It's not just JBA that are talking about this, as we're all aware. The regulators are also involved, as are the wider insurance industry. I've just included a quote there from a Lloyd's Market Bulletin released on the 10th of July this year. One of the key areas of focus identified in that bulletin was climate change. In addition to this, in 2015, the PRA released a report that was solely focused on looking at the impact of climate change on the insurance industry. Now, other key uses of the model and tools similar to this is knowing where risk will become more or less susceptible to flood, which could allow for portfolio diversification. But essentially, we hope that our model will provide you with a quantifiable, tangible impact of climate change on your portfolio. So let's talk a little bit more about this model then. Well, it's the first climate change flood model on the market for the UK. It provides an indication of loss by 2040 for 3 different flood types: river, surface water, and coastal, under a realistic warming scenario. It's been developed using government-led spatially variable climate change allowances, which I will discuss in more detail in a few minutes, which should enable easy identification of areas more or less susceptible to flooding, as I mentioned previously. We've developed this using our new released UK Flood Model 2018, which has market-leading 5-metre flood maps that you may be familiar with already, and allows for building level resolution analysis as well. It also has our UK Flood Event Set, which is a statistical event set for 3 flood types containing over 100,000 plausible events. And this is where we have generated our climate change model. So we've adjusted our event set using a series of climate change allowances. These denote a percentage change in a flood type, for example, peak river flow. We've used 2 different sources to generate the UK climate change flood event set: the UK Climate Change Risk Assessment Report that I introduced previously, and UK Climate Projections 2009. This is a climate analysis tool that features the most comprehensive climate projections for the UK and is funded by DEFRA, but co-managed by the Environment Agency and the Met Office. It has contributions from over 30 organisations and continues to be used by the UK government to help assess the potential impacts of climate change on the UK. And I've included an example of the resolution of the data available from UK climate projections in particular on the right-hand side. What you can see is the change in rainfall on the wettest day of winter at 25-kilometre grid resolution across the UK. Essentially, both sources are derived from government-approved, peer-reviewed data, and I've included some of those sources in the imagery below. Now, what have we done then per flood type? Well, for river flood, we've used allowances that quantify the percentage change in peak river flows, and these can range from projected changes of a reduction in southeast England to an increase in northern regions of Scotland. For surface water, we've used UK CP09 wettest day of the season at 25-kilometre resolution that I mentioned earlier. And this is defined as the 99th percentile of daily maximum precipitation on a seasonal basis. Again, these range from reductions in the summer months in southeast UK to an increase in autumn in the west and north of Scotland, for example. The data is derived from ensemble climate model projections that consist of multiple variants of the Met Office climate model, as well as climate models from other centres. And because it is one of the contributing data sets used to generate UK climate change risk assessment allowances as well, it's possible to link the emission scenarios between the two sources. Finally, for surge, we've utilised allowances for relative sea level that take into account the vertical land movement. The image on the right is an example of the river flow allowances taken from the UK climate change risk assessment for each river basin or catchment, expressed as a percentage change to the peak river flow. And this should hopefully just give you an indication of where some of the changes are happening. And it's all well and good having such allowances and such data available, but there's obviously got to be a degree of confidence in that information. As I mentioned previously, this is government approved data, and so it is the latest science available on the topic of climate change for the UK. However, there is always a degree of uncertainty related to modelling. Such uncertainty can stem from complexity of the climate system. It can also be due to natural climate variability or uncertainty of the future pathway of greenhouse gas emissions, for example. And the image in the lower right corner there is just to highlight the uncertainty related to climate modelling, really. This is a black line denoting the observations, and then the rest of the squiggles, as I will call them, is to essentially demonstrate the variability within ensemble climate modelling that some of you may be familiar with. To deal with other types of uncertainty, UK Climate Projections 2009 presents projections as probability levels for a range of possible outcomes. The probabilities are expressed in percentages ranging from 10 to 90%, with the 50th percentile as the median or central estimate of change, which is the image in the top right there. So you may be wondering, well, how have you actually applied this to your UK climate change flood event set? Well, each event in our event set is defined in terms of the return period of the hazard intensity at all affected locations. To estimate the return period in years of a given hazard intensity, a probability distribution is fitted to the flow, rainfall, or sea level data at each modelled location using the peak over threshold method. So then we take the climate allowances, and to obtain the climate change adjusted return period for a given hazard intensity, we adjust the probability distribution fitted at each modelled location. The application of the allowance changes the peak intensity of the hazard, which essentially then fattens or thins the upper tail of the probability distribution, highlighted here, representing the impact of the climate change allowance on the probability of exceeding a given hazard intensity. Essentially, this has the biggest impact on the extremes, but can also affect the lower return periods. For example, an event with the same hazard intensity may become more frequent in UK climate change flood model. Now, what we haven't done is just to blanket uniform adjust our UK climate change flood event set. So what impact does this then have then? Well, the number of events in our event set has not changed, but the number of events exceeding a return period threshold has. And this is what the plot on the right-hand side is illustrating. The graph shows the number of river events in the original event set, so our UK flood event set used in our UK flood model 2018, denoted by black bars. This is alongside the number of events in the modified event set with a maximum effective return period exceeding the return period thresholds on the x-axis. I'd like to just highlight from this plot that the higher return period's relative change is much larger than at the lower return period threshold. So for example, if we take the 1,000-year return period threshold, this has 3 times as many events exceeding this threshold compared to 2018 by 2040, whereas events exceeding the 10-year return period threshold is only marginally more than in 2018. This example is for river flow, but for rainfall, we also see a greater effect on events in autumn and winter than in spring and summer, which is consistent with the magnitude of allowances for those seasons. And for coastal, we actually see about a 50% increase in the number of events above the 1,000-year threshold. And then we move on to the impact then on event frequency. So across most of the country, we actually do see an increase in events of a certain return period, but this isn't true for all areas, for all flood types. And again, I've used river flow as an example here. The 2 plots show that in the southeast of England, we have a lovely mirage of blue. So for most river locations, present-day 200-year events become up to 5 times more frequent, which is denoted by colours essentially other than blue on those plots. So the new return periods range between 40 and 200 years. And for 1,000-year events, we see them becoming up to 10 times more frequent. However, for locations in the southeast of England, again denoted by that blue, 200-year events become up to twice less frequent, and 1,000-year events up to 5 times less frequent. So there is a clear pattern of flood events in river flow generally becoming more frequent in western parts of the UK and less frequent in the southeast. Now for surface water, again, we see autumn rainfall events becoming more frequent over western parts of the UK. And for surge, compared to river and rainfall events, the frequency change is less pronounced. Spatial patterns indicate that locations along the south coast of the UK and in northern Scotland are actually most impacted by climate change. Now, I'm sure it wouldn't be that much of an interesting presentation if we didn't provide you with some sneak preview of some of our results. So here we go. I'm gonna flick over this in about 5 seconds. Okay, joking. So here we have 2 plots that show the change to annual average loss for a residential market portfolio, with the left plot showing the change for river flood and the right plot showing the change for all flood types. Grey denotes a decrease in the AAL, with the darker orange denoting a much higher increase. And as you can see, the change in loss is not uniform across the country for different flood types, which is as to be expected when we take into account the climate change allowances. The higher resolution quantitative results behind these images are what will help you determine where is more or less susceptible to flood, however, and how your portfolio may evolve in the future. At the start of this presentation, I mentioned that we've utilised the UK Flood Model 2018 building level resolution and data, and this means that this is quite aggregated information that you can view on your screen at the moment. We can go much higher resolution to provide accurate results for you. And the results here do show the relative change as well, so please take them with a pinch of salt. They are not absolute values. Bear in mind that the relative change in southern Scotland, for example, appears similar to northwest England, but the absolute loss amounts provide a more interesting picture. The results are as well, of course, portfolio dependent, so you may see different results when considering your own portfolio. And as I mentioned already, these maps are quite coarse resolution. We do have the capability to analyse at building level, as well as your own exposure level using UK Climate Change Flood Model. Well, how do you validate a model then when it is the first one in the market? Well, I can tell you it was slightly tricky because there are limited tools available. However, we were able to compare with our UK Flood Model 2018 results to provide an indication of change, and some of those results you've seen on the previous slide. And our headline is that results suggest an increase of 25 to 30% in our average annual loss by 2040. And this is based again on a residential market portfolio. Now, I want to mention that although we found it challenging to validate the UK climate change flood model because of the limited tools available, our UK flood model has been fully validated, and so we have high confidence in our maps, event set and exposure data used to generate our UK climate change flood model. We can also use the UK climate change risk assessment to provide some context from their future flood explorers results. However, this is not focused on insured losses and only provides information on expected annual damage, which is not defined in the report. But I have included the headline there that they are set to increase by 25% for a 2-degree warming scenario, and that is by 2050. So I just wanted to finish on how you might find using the model. Essentially, the key message here is this model could be extremely useful to you. It can be used across a range of financial services industries, from underwriting to reinsurance to longer-term portfolio management, mortgage lending, to understand changing risk to properties as well. And I know, James, now I'll pass back to you to talk a little bit more about how we can access the model.
Okay, thanks very much, Sarah. So let's talk about how you guys as customers can actually get access to the JBA climate change model. So it's a very simple process. We have a model license agreement that can be signed up to via the MODEX contract. We can provide training on the platform, kind of how you get data in and run models through, and the outputs you get from those models, and then we can very soon after that get you connected and access to MODEX. And as I said earlier, this is a very simple process which incorporates basically getting a login and a password, and then you will be able to log in via a secure browser. Once you've done all that, you're free then to use the model, and our guys here will support you all the way. So if you have any issues, we're here to support the end-to-end environment, and that includes all of the technology, the Oasis stack, and the model technology as well. So it really is a kind of end-to-end service that we're providing.
I think then we can move on to some questions and answers. So, okay, why are losses estimated for 2040? An interesting question, good question. JBA has basically used the latest government-led science to develop the model, as I mentioned previously. So these data sources do offer the opportunity to analyse changes for several different time series, but JBA selected to look up to 2040 because we feel it is of most relevance to our clients. So using the time frame, the model does offer near-term results which are tangible and do enable you to develop realistic strategies to deal with climate change. Okay, so why do losses reduce in some areas but increase in others? Well, the climate change allowances used to develop the model do vary spatially across the country for each flood type. So for example, I talked a bit about the river flow allowances. They are available per river basin region or catchment. And so as projections suggest a reduction in peak river flow in the south of England by 2040, that's compared to an increase in the northwest of the country, for example. So this is then reflected in the loss estimates across the country. Okay, so what is the likelihood of the warming scenario used then? The warming scenario used in the UK climate change flood model is reflective of something you may be familiar with, which is the Paris Agreement, which is signed by, was signed by 195 countries in 2015 at the Paris Climate Conference called COP21. This was the first universally kind of legally binding global climate agreement that set out an action plan to try and avoid dangerous repercussions, I guess, of climate change by limiting global warming to below 2 degrees by the end of the century. And so JBA's actually utilised this as the warming scenario for the model because it is considered then the most realistic by most nations in the world. A question that says UK CP18 is due by the end of the year. Will you be updating your product based on this report? Yes, I've actually been involved in some of the discussions around UK CP18, which looks like a really interesting tool, and it's great to see that it will be updated. We certainly would love to update our model to accommodate the latest data, and it's certainly something that we will be discussing going forwards as to what we can do to improve the model for the future. Another question here says, does the decrease in annual average loss for the southeast not outweigh the increases elsewhere, given the concentration of exposed values in the southeast? That's a very interesting question. And I think what we need to bear in mind when we're thinking about annual average loss is that, as I mentioned, it is portfolio dependent, and it is also quite dependent on flood type as well. So albeit we see a decrease in AAL for river flow, for example, this may not be consistent with the other two flood types. And because of the magnitude of change across the country, it may not outweigh the differences that we see elsewhere. So what I would recommend there is that you consider your own portfolio and perhaps which flood type it is most focused on and for which reasons, and then we can provide you with something quantitative and tangible to take away from that then. Another question on what RCP, so representative concentration pathway scenario, was assumed. For those that don't know or aren't familiar with RCPs, they are included in the Intergovernmental Panel on Climate Change AR5, Assessment Report 5, which was released in 2014, a reference of which is available in this slide deck at the end. And they project the concentrations of greenhouse gas going forward into the future. Now, because we've used a select warming scenario, we haven't got a specific RCP that we've particularly selected. However, what we have done is do some research to better understand which RCP our warming scenario is most closely related to. And looking at projections and the research available, the RCP that it is closest to is RCP 4.5. It sits quite nicely actually between 4.5 and 6, which are considered the most realistic scenarios going forward. Is there any technical documentation available to understand the technical detail of how changes are applied? Yes, there definitely is, and I'm not going to claim to be the statistical expert that derived all of the probability distribution function work that I mentioned earlier. And we do have a technical report available, and that is available to clients licensing the model. Of course, we would also recommend, if you are interested in more information, then you can just come straight to us to discuss with us in more detail. Someone's asked about a 15-kilometre grid because of ECMWF, which is the European Centre for Medium Range Weather Forecasting, or something else. There was no 15-kilometre grid, it's a 25-kilometre grid from UK CP09. And the reason for selecting the 25-kilometre grid, because for rainfall especially, that varies so much spatially, and it's really important to try and capture as much information as possible when considering weather phenomena like extreme rainfall. I understand I might be presenting to quite a few experts in flood and height data, where actually 25 kilometres seems very coarse, but in the world of climate modelling, we're just about getting up to 5 or 1 kilometre modelling. So for the data available, we were slightly limited in what we could use. However, as I've mentioned, UK CP09 at the moment is still the most up-to-date information that the government recommends and uses for its own planning and adaptation to climate change. So I think we'll just take one last question before we wrap up. But if you do have, there's actually been a lot of questions coming through, and I'm afraid we haven't been able to answer them all today. But I'm hoping that we can take note, and then perhaps if people want to get in touch, then we can answer and discuss further. So there's a question just again about the kind of methodology, and as I mentioned, I'm not the technical statistician expert that applied the climate change allowances to the probability distribution functions. However, as I mentioned, we're more than happy to talk about that in more detail if you do get in touch with us. But to incorporate climate change, we've adjusted our UK flood event set, which is in our UK flood model. And this is a statistical event set with over 100,000 plausible events in it. And then we've used the climate change allowances for each flood type to generate a probability, we've generated a probability distribution function at each gauge for each flood type, and then used the climate change allowances to adjust the peak hazard intensity. And so the application of the allowances actually changes the peak hazard intensity, which fattens or thins the kind of upper tail of that probability distribution graph that I showed earlier. So I think that wraps up the webinar for today. Thank you everyone for attending. And as I mentioned, please do get in touch with us at JBA or via Simplitium to ask more information on the model and any further questions that you might have. But that's it from me, and thank you very much for joining.